All right, welcome guys to our Finance Friday weekly course. I'm Jerry, the owner and founder of Wealth Dynamics. And every week I come to you with a live course on finances. Okay, so we talk about how to gain financial education. We talk about how to increase our income, increase our savings, increase our financial understanding. Ultimately, the goal is though financial education so that we can build solvency and then wealth. And so one of our focuses on this tonight is going to be taxes. Right now, I've talked about taxes before. And we're going to go over some review tonight, some things that we've probably heard, also some new things. But the main focus is going to be the synergy between taxes, not only the planning and filing, but also accounting and bookkeeping, right? These are parts that get left out. Now, I'm going to talk a little bit about my journey as an entrepreneur with this topic, because taxes are something that really didn't matter to me as a young person, W-2 income. As I started to earn more money in my business, taxes became more important to me. And as I started to realize I need to be profitable in order to grow my business, that's when accounting and bookkeeping became important to me as well. So we're going to kind of cover the whole shebang. Now, I want to start this out with the same thing I say every time, okay? So first things first, if you're brand new to this, you never heard anything about finances, you've never seen a Finance Friday before, you've never tuned in, we're going to go over a lot of stuff, and it's going to be stuff about money. Money is heavily mathematics and vocabulary. The base layer of everything finance is basic mathematics. It's arithmetic. So if you can add, subtract, multiply, and divide, you can understand everything we're going to talk about in this course, right? Now, the only reason why somebody gives up on the topic of money, the only reason why somebody can't understand money, it's got nothing to do with the math. It's got everything to do with the layer of vocabulary inserted over the math, right? So if we have math here, over the top, we have vocab, right? We have to come up with names for all of this stuff, right? Now, if you're in the good old boys club, all the vocab is simple, right? All of it's simple. Like one of my mentors said growing up, if you can't draw an investment on a napkin, it's probably not a good idea, right? So we have vocab here, but then above this vocab, we have something called nomenclature. Okay, nomenclature is the specialized terms that the industry professionals and that the fat cats and the blue bloods on Wall Street came up with to confuse you and I to make us feel like we need them. Okay, we're going to try and avoid nomenclature tonight. We're not going to use a bunch of fancy terminology. Now, granted, we are talking about the tax code, right? Albert Einstein was quoted as saying the tax code is the most confusing thing to understand in the world. That's Einstein, right? So we will get rid of the nomenclature, but there's some of the vocab and math that may not immediately be simple. And so I want you guys asking lots of questions as we're going over this. If there's anything that doesn't make sense, I want you to drop that in the comments. If at any point you feel like you're lolling out, giving up, getting bored, wanting to quit, falling asleep, etc., it means I said something that you, the viewer, didn't understand. That's it. That's as simple as it gets. So if you're watching this, I want you to keep me accountable to that. Drop questions in the comments. Second thing, be positive. I don't think we have a lot of issues with that anymore. Facebook seems to censor everyone. That's the downside. I guess the upside with all the censoring is a lot of people get censored, right? That includes negative people. But Facebook does a good job of keeping that pretty clean. So stay positive in the comments. Try and be a contributor. Think about how to apply the information. And then very last is we will go live at the end of this. I want to see questions. I want to talk with you. We will go live on air. So if you're in Zoom, drop your questions in the chat feature. We'll actually go live and answer them. If you're on Facebook, unfortunately, we can't do that, but I will read your question and answer it. Okay. So the topic here tonight, taxes, right? None of us like taxes, whether you're a Democrat, whether you're a Republican, whether you're a libertarian, nobody likes paying taxes, right? We all might want to tax this group or that group or lower taxes here and raise taxes there. But all of us can agree that when it comes to our paychecks, we don't like it when taxes come out, right? We also don't like it when tax season comes around and we owe money. None of us like actually taking money out of pocket, paying it to the IRS. I tell this story all the time about my first paycheck. Okay, my first paycheck, I was probably 17, 18 years old, delivering pizza. Right. I wasn't supposed to. That was actually illegal. My boss let me drive anyways. I was under the age of being allowed to drive pizza in Alaska, but that's fine. But I got my first paycheck and I was expecting like $800, right? And I got like $500 and I didn't know why. And I was like, well, I worked all this time. I put in these hours. Where is the extra money? Where's it going? Right. And so it turned out that was taxes. That was my first taste of paying taxes. I'd heard my parents talk about it. I'd heard my teachers talk about it, coaches talk about it. I had never experienced it till that paycheck happened. Okay. That's called a withholding, right? So my income came in, before I got any of it, it came off the top, right? So that's called a withholding. And I experienced that. And then basically I was like, I've only got $500, even though I worked for 800. Okay. As I grew into an entrepreneur, as I started making more money, that magnified, right? It was, I made 10,000 and I only get 7,000. I made 100,000. I only get 60 of it, right? And it starts hurting more and more. And that's where we all start focusing on, how do I reduce my taxes when it becomes painful, right? What I want to talk to you about tonight is, how do we do it in a proactive way? Because if you're waiting till it becomes painful, it's too late. Now, I'm not saying it's too late, like you can't do anything, but I'm saying you need to start before it gets painful, right? It's like this old story about this dog, right? And I forget where I heard this, but the old adage is, there's a guy sitting in his rocking chair, dog laying down on the ground next to him, and the dog is just whining and howling. And so, a worker comes in the room and he sees the dog laying on the floor, whining and howling and whining and howling. And the owner doesn't seem to care. He's just sitting there, kicked back, right? He's rocking. But the worker's like, sir, what's wrong with that dog? And he's like, well, he's laying on a screw. And the worker's like, well, shouldn't we get him up? He's like, I've already tried. He won't get up. Right. And so this dog, the moral of the story, the dog is in pain. The dog knows it's in pain, but it won't actually move because it thinks moving is more uncomfortable than handling the pain. That's taxes, right? Now, a little bit of history on taxes. Prior to 1913, federal income tax was illegal in the United States of America. Okay. In 1913, two things happened. We had the Federal Reserve Bank come into formation. We also had, in the same year, the IRS come into formation. Okay, so we have the Federal Reserve Bank and then its collection agency, the IRS. In that year, we also then started to initiate income tax. Now, in the 1940s was when we started really heavily taxing public employees, right? So Americans went from voluntarily paying taxes where the IRS didn't touch their paycheck. We got 100% of our wages. And then at the end of the year, we would shore up. We would pay them what we owed based on what they said. And then we'd shore that up at the end of the year. In the 1940s, we went to a W-4 withholding system, which we still have today, by the way. Okay, that means that before you get paid, the IRS takes the money out of your paycheck before it ever hits your bank, and then they make the money off of your money first. At the end of the year, they give you a tax refund, right? That's in the 1940s. Now, I want to point out on the history of this, this was supposed to be temporary. Okay, this was supposed to be to fund World War II. That was it. It's supposed to be temporary, but the IRS realized that, well, if we go back, we're going to lose tax revenue. Okay, Americans, the number one thing that we're all good at is overpaying in taxes. Is to the point that the average person today thinks that a tax refund is a good thing, right? I thought tax refund season, it's great. I'm going to get my $2,000. I've been waiting all year for that. And then someone explained to me, no, Jerry, this $2,000 that you're bragging about, this is a refund. Okay, a refund means that it was a return surplus. The IRS took too much of your money, Jerry. They held it all year long, Jerry. They didn't pay you any interest, Jerry. And then they gave it back to you in a refund at the end of the year. And you're celebrating. You just got stolen from. When someone explained to me that sequence, it clicked. And I was like, okay, this tax thing, I've got to figure this out, right? Now, here's the problem is most people never get beyond the refund because they don't save money in the first place. So one of the things, if you're a beginner with taxes, you've got to realize it's your job to save your money. No one's going to do it for you. The government shouldn't be doing it for you. If you're not on a forced savings plan, building financial freedom is impossible, right? So a refund should not be celebrated. A refund means that they took my money. They didn't pay me anything, right? As an investor, if I gave somebody $2,000 and I let them hold it all year, I'm expecting a 10, 12, 15 higher percent return on that money as an investment. If I don't make anything, that's called opportunity cost, meaning if I had invested at 15%, I would have made 15, but since I didn't and I invested it with the IRS at 0%, it actually costed me 15% because I'm losing out on that money. You guys see that? Okay, so we have to get out of the mindset that a tax refund is a good thing. That's not a good thing. We want to have that money back in our paychecks every month. And that's the first thing we've got to realize. Now, here's what we're looking at. We're looking at a couple of cycles. All of us are excited about tax reduction. Okay. All of us are excited about tax reduction. We have really three groups of people. We have the poor, we have the middle class, and we have the wealthy. Okay, and you could say there's upper middle class, and then there's the top 10 and the top 1. We're just going to divide it into 3 categories: poor, middle class, and wealthy. Now, when we hear politicians talk, we hear, most news heads, talking heads on TV talk. We hear about how these guys, the wealthy, evade all the taxes, right? And they don't pay their fair share, and the poor and middle class get the brunt of it. Right. And that's the rhetoric that we hear. That's the word on the street. That's the thing that's repeated over and over. It's tax the rich, tax the rich, tax the rich, give the middle class a break. The rich aren't paying their fair share. If you look at the stats, guys, I want to point this out. If you look at the stats, the most tax evasion happens right here. Middle class, Schedule C business owners. Okay. A Schedule C means a sole proprietor. So as a business owner, when I file my taxes, I'm either a sole proprietor, meaning I file as an individual. There's a form called a Schedule C, and I fill out all my business expenses on there, and nobody checks them or audits them. I don't have to produce a profit and loss statement, and it's very unofficial. Okay. So this is called a Schedule C. It's a form that I fill out. Okay. Now, because nobody checks that ledger, this Schedule C business owner commits more fraud and more tax evasion than this wealthy guy. The wealthy guy, he files in either an S Corp or a C Corp. Okay, an S Corp and a C Corp. He's got to pay himself a salary. We're going to talk about that tonight. He's got to pay himself distributions or dividends. We'll talk about that tonight as well. All of that requires accounting and bookkeeping, right? The accounting and bookkeeping means that when the IRS audits this guy, his S Corp or his C Corp, right, they actually can see he has a ledger where he said, here's what I'm going to spend. And then he has a reconciled ledger saying, here's what I did spend, right? It's double entry accounting. And so the chance that this guy can commit tax fraud is significantly lower because there's double entry accounting, and the IRS can go have him produce those profit and loss statements and say, okay, great, we can see where you came up with your numbers. Schedule C guy, not so much. This is the guy that either does nothing or he's doing QuickBooks by himself. He's got no bookkeeper, no accountant, no nothing. He's doing Schedule C, and he just puts whatever he puts, and he's writing off stuff that he legally shouldn't be able to write off, but he knows he's probably not going to get audited. And so most of the tax evasion happens in the middle class. Now, what I'm going to talk about tonight is not tax evasion in an illegal sense. We're talking about legal methods to reduce taxes. Okay. Legal methods to reduce taxes. Now, in order to do that, let's actually start at the end. We'll say tax filing is the last step, right? There are actually different seasons to taxes. This is the one everyone thinks about. Tax filing season, April 15th comes around, and we're all like, okay, great. I need to file my taxes. I need to get my taxes back. Maybe I get a refund. Maybe I got to owe. Who knows? I'll find out when I file, right? For those of us that want to reduce taxes, we can't just file and expect a CPA to be like, voila, and then taxes get reduced. Okay. Before tax filing can happen, we have to do something called tax planning. Okay. Now, I want you to think about this word planning. What is better? A half-assed plan done on a whim in as little of amount of time as possible, right? Or a very thorough, very well thought out strategic plan that accomplishes not only our short-term objectives, but it also accomplishes our long-term strategy. The second one, we all want the second one. We want to have our short-term taxes reduced. We also want to have a long-term strategy. We want it done compliantly. We want it done right. Even if it's not the fastest thing in the world or the most easy thing in the world, this is planning that happens to do with taxes. Right? If you're doing a business plan, same thing. You're not going to be like, man, I want the quickest, fastest harebrained business plan we can come up with. No. You're going to be like, no, I want the most thorough, well thought out, well-researched business plan. I'm willing to pay the extra money for it. I'm willing to wait the extra time to have it done right because I want a good business, right? With taxes, I want to get a good plan in place. I'm willing to pay the extra time, money, if effort, education, because I want to pay as little in taxes as possible. And I want it to be final. Because here's the problem. Here's the problem and the beauty of the tax system, right? Have you ever wondered why you have your paycheck, your W-2 or your 1040 or your Schedule C or your K-1s or whatever you're using, and you report your income to the IRS, and also your employer reports your income to the IRS. But then at the end of the year, the IRS asks you, Jerry, what did you earn? Even though we already know, because your employer told us and you told us, and we have all of this data, we want to know, what did you earn? We want your opinion of what your earnings were. right? Who's ever wondered that? Why do they ask you twice? It's like when I was a personal trainer, okay? We'd have a client check in at the front desk. Front desk would ring them up. So the gym knew, right? The gym knew that it was basically something that the client paid for and it was a training session. But then me as the trainer, I had to get a receipt and a voucher and produce it at the end to give it back to the front desk to prove the session happened, even though the front desk already knew. And the reason why is the gym wanted me to lose the ticket so they could not pay me for the session, right? Because if I couldn't prove that I did the session, they didn't want to pay me any money, right? And so that's the same thing that's happening here. And so if I can't produce my numbers and show, here's what I earned, here's what I spent, here's what's deductible, here's what's not deductible, here's my strategy, here's where it came from, here's where the tax law says it's legal, here's the areas that I stayed inside, we didn't do any gray shit, we just did black and white, and I can't produce that in an audit, then the IRS can come back and they can take those deductions away, and then they will penalize me in arrears. Okay. No different than the personal training tickets. Like if I couldn't produce the ticket, even if I just worked an hour with a client and I go to the front desk and they saw me do it, but I couldn't give them that ticket, they're not going to pay me for the session. Okay. So if you file the greatest taxes, in the world, and you have no liability, and you did the most creative stuff you could think of, and you Googled all this stuff and you hired the best people, but you didn't have a good tax plan to produce to an auditor, if you got audited, to say, here is what we did, here's where we got it from, here's where it's legal, here's where it says it's legal, and this is all the verification, then they can say, sorry, you were going to pay 50,000, you got it down to 10. That's great. That sucks though, since you can't verify any of it. We're going to go ahead and charge you the 40 anyways, and penalties on top of that, right? So it's tax filing and then tax planning. Now, tax planning is based on data. As a new entrepreneur, I did not understand this. Okay, I thought that they were just loopholes. I would call them loopholes, or wormholes, or those little scams that we get out of the system with. Those don't exist, guys. There's no such thing as a tax loophole. It's on the IRS's freaking website. Like you can go look at the tax code. It's public information. There's not loopholes, right? It's maybe loopholes if you can't read, right? If you can't read and you're like, man, I don't know where Jerry comes up with this stuff. He must have a bunch of loopholes. But for all you guys that are literate, you can go on the IRS website and read the tax code too, and you'll see that they're not loopholes. They're spelled out in black and white, right? But it's based on my data. And so if I don't have the proper accounting, right, to show my tax planner to say, here's what I earned, here's what I spent, they can't do a tax plan. Okay, the tax plan is based on my data. And if I don't produce that data, they're going to be like, dude, I don't like, you want us to make up numbers? Like we can't base this off of nothing. It's like going to the doctor. I was actually explaining this to one of my staff today, because a referral came in and they were like, I don't want tax planning. I want tax filing. Okay, just file my tax. I don't need a plan. I don't need anyone to analyze my stuff. I just need filing. And so I explained, and I had my staff explain, we do a tax plan for the same reason that when you go to a doctor, you do a checkup, right? Like if I have stomach pain and I go to the doctor, right? Let's say I go to see Dr. Ryan here. I'm like, I have stomach pain. I don't know if Ryan would handle this. I don't know if this is his field, but I'm like, hey, I have stomach pain. I'm fully convinced I need chemotherapy. Fully convinced. I've researched it. I've read it on Google. I talked to my brother-in-law, right? I went on one of those online forums where they talk about, holistic medical stuff. And I'm fully convinced I have stomach cancer. You need to give me chemo. If that doctor listens to me and gives me chemo, he's probably going to lose his license to practice. You always do a checkup, because what if I don't need chemo? What if I have an ulcer, right? Or what if I just ate something bad, right? Ryan says he'll rub my belly. Thank you, Ryan. I appreciate that. But what if I just have an ulcer and then Ryan hooks me up with chemo and then I freaking die because I didn't have chemo because we never did a checkup, right? And so this is why we do tax planning. Now, doing a checkup means he's going to look at my current condition. He's going to look at my stats, right? He's going to look at my height, my weight, my blood pressure, my heart rate. He's going to go back and compare that maybe with my medical records. And he's going to say, based on all of the data, here's what I think we need to do, right? In the finance world, accounting is the data. If you can't show me what did you earn, what did you spend, and have that in a neat, detailed report, I can't give you a plan, right? Now, before accounting comes payroll, right? Now, these are the two that are boring. Nobody wants to talk about payroll and accounting, right? Nobody wants to talk about them. Nobody wants to spend time on them, and no one wants to spend money on them. But I'm here to tell you, the way you pay yourself matters. As a business owner, I learned that the hard way. Okay. When you're a Schedule C, a sole proprietor, meaning I'm an LLC, but I got the LLC. I used to think an LLC was a tax break. I was like, man, if I can just get an LLC, I'll pay no taxes, because that's how LLCs work. Because we all know that, right? So I get my LLC. I think I'm set. I'm like, cool, I got the LLC. Now I don't have to pay taxes on any of my business income, right? Can you see how dumb I used to be? Jerry Fetta, the finance guru, that's what I used to think. And so I set up the LLC, and at the end of the year, I find out I owe income tax, and then I also owe something called self-employment tax, because my LLC isn't recognized by the IRS. It's a disregarded entity. They don't acknowledge the existence of an LLC. That's only something that's acknowledged at a state level, right? And so if I file as an LLC, the IRS is like, we don't care. You're a person. You're not an LLC. We're going to tax you as Jerry Fetta. Now, because you earned your own income and it wasn't from a W-2, that means your employer, which doesn't exist, didn't pay Social Security or Medicare. So because you didn't have an employer pay Social Security and Medicare, you have to pay Social Security and Medicare. That's an additional 15% on top of your federal income tax. Thank you very much. You owe us this, right? I didn't set aside for that. I didn't plan for that. I wasn't aware of that. So I'm looking at, 15 to 20% federal tax. Luckily, I lived in Alaska. There was no state tax, but then also another 15% in self-employment tax on top of that, right? Because my payroll wasn't set up correctly. Okay, if I had done my payroll correctly, I would have known that I should have done something called an S election. I should have paid myself a minimal base salary. I would pay self-employment tax on that salary and my federal tax on that salary. But everything beyond that salary could be a distribution, and I don't have to pay self-employment tax on that distribution, right? Or I could have done a C Corp, right? I could have done a C Corporation. And if I set my payroll up where my first $80,000 in profit was paid to me as a qualified dividend, the federal tax rate is 0% on dividends. I would have paid no taxes on that. My corporation would have, I wouldn't have, right? So my payroll really matters. Am I paying myself as a sole proprietor where it's all just taxable self-employment income? Am I paying myself on a base salary with distributions? Am I paying myself on a dividend? Am I paying myself on a draw? Or is it a loan, right? Like, is the corporation loaning me money so that I'm taking a loan from my company and it's not actually income? Or are they giving me my basis where I started a company up, I put 100 grand of my own capital into it, meaning my 100,000 of profit, my first 100,000 isn't taxable because it was my own money in the first place, right? So this stuff matters, but it's overlooked because we don't do payroll, right? We just send ourselves money, or we set up a QuickBooks account. We don't consult with anyone. And what ends up happening is we start a tax plan. I start working with you. My team starts working with you, and we're like, bro, what the hell? Like, how are you paying yourself? And you're like, well, we pay ourselves this wage. Yeah, but how? Is it a W-2? Is it a 1099? Is it a K-1? How are you doing it? And you can't answer that question. We end up going on an Easter egg hunt and finding out you're still a sole proprietor and you're going to pay 15% more in taxes because of that. Or you're set up on an S corporation, but your bookkeeper, who's not a tax planner, who is not looking at reducing your taxes, gave you a compliant salary, but they gave you a really high one, and we could have gotten away with less. And now you're overpaying on your salary because your bookkeeper is afraid of being audited, right? All this stuff matters. And so payroll is where it all starts. Now we get into accounting next, right? Accounting is where we get the deductions. Okay, the deductions don't happen on tax planning. Tax planning is where we summarize what you can deduct, and we might put together some other strategies. But what classically happens is, just this year it happens, right? 2020 is done, right? So in April, we're filing for 2020's taxes. Well, people don't know the difference between tax planning season and tax filing season. And so in tax filing season, they're asking for tax plans. The tax year is done. We can't plan for a year that already happened. That's called fraud. I'm sorry, but we can't go back in time and cook your books in arrears and say, oh, no. Nano spent all this money last year, even though none of it's documented, and it all technically is on his 2021 credit card statements. But trust us, it was from 2020 IRS. We're telling you the truth. No, it doesn't work like that. So I have to look at, okay, my accounting happens during my operating year, during my tax year. So if I'm looking at 2020's taxes, in 2020, I need to be doing my accounting, meaning every month I generate a profit and loss, right? You can use our programs for that. We have one for sole proprietors, side hustles. It's tax.wealthdynamics.com. It'll track all your expenses for you. Our bookkeepers will text you. You let them know what's business, what's not. They'll build your profit and loss. Super easy. Or you need help with it. Maybe you're still doing it yourself, but you do need some oversight. We have a program where every quarter we'll review what you did. We'll fix your mistakes. We'll give you recommendations on the future, and then we'll see you again next quarter. Or maybe you're running a full enterprise and you're like, hey, I don't want to do the bookkeeping. Okay, I'm willing to pay the money to have someone else do that, right? So I'm going to pay for accounting. I'm going to pay a couple $100 a month or a couple, $500-600 a month. But the bookkeeping team, they're going to do it all for me, and they're going to build out my profit and losses so that when it comes to tax season, I can just hand over what I spent and say, what do my deductions look like? Okay, because otherwise it becomes more expensive. If we don't do the accounting here, we have to do what's called cleanup. Cleanup means that you didn't do your accounting and it's tax season. And now our team has to go back. It's 2021, but our team has to go back from January 2020 to December 2020. And they have to do forensic accounting on all of your bank statements to find out what you spent, what you could have deducted, what you did deduct, what you didn't deduct. And they don't like doing that. They're going to actually upcharge that. It's going to cost you more money because they're having to go back and clean up your mess and go on what we call an Easter egg hunt. It's not as exciting as when you were a kid where you get candy. Instead, you just look at numbers all day and try and figure out where money went. It's not something that you want to do. So do the accounting ahead of time. Okay. Now, accounting is important because not only does it give the tax people, the planning team, something to look at, as a business owner, accounting is how you scale your business. Okay, I'm going to repeat that. As an entrepreneur, as a business owner, accounting is how you scale your business. If you don't know how much you profit per sale, per unit, how much you spend on advertising, what your return on investment is on that advertising, what your average production per staff member is, how much goes towards payroll, how much goes towards commissions, when you make $1, how much of that dollar you keep, all of this stuff helps you plan for expansion. Okay, because what ends up happening is business owners don't know their accounting, and then they try and expand based on, bright ideas and whim. And then they end up drowning because they didn't actually make any money on their bright ideas because they didn't know what they make when they spend money, what they make on their net profit, what their cost of goods were, what their salaries are, what their payroll is going to be, what their promotion costs are going to be. And so they end up, buying a bunch of new technology or developing new products or hosting events or going to masterminds or just spending money in any random pattern without any idea of what the return on investment is going to be because they don't know their books. Okay. One thing about me, and you guys should be able to assume this, but as a business owner, I'm obsessed with the numbers. Every single week, we do double ledger accounting. We look at what did we say we were going to spend? What did we actually spend? What's the plan? What was the actual? Okay. If it's off by $1, I want to know why. Okay. If there's more money than there was supposed to be, I want to know why. If we made more income than I planned, I want to know why. If we made less income than I planned, I want to know why. Right. If our cost of goods on bullion was more than it should have been, I want to know why. All of these things are in my numbers. The numbers tell the story. Right. I shared this with my Facebook group today. This is an old story. I got this from John Rockefeller's biography. There's a story of him actually back when he was running Standard Oil. He went out to the production line and he was just looking over the production. He realized when they were sealing up the barrels of oil and kerosene, they were using solder, right? And so they're using I think it was 35, 36 drops of solder per barrel in order to seal it. And so he wondered, well, how far can we go down on those drops to reduce them before that barrel starts leaking? Right. So he had his men take a test barrel and run it through, and he reduced it by 2 or 3 drops and 2 or 3 drops until it started leaking. I think it was around when they brought it down to 27 or 28 drops of solder. That's when the barrel started leaking. He said, great, I want you to do one more drop than that and run it through again. So they did. They did one more drop than that, ran it through again, and it didn't leak. And he said, great. So we're gonna do 29 drops of solder instead of 36 per barrel. Okay. He knew his numbers down to the point of how much money he spends per drop of solder. And he was able to calculate that per round of production they did. He saved himself $5,000. Right? Like that blew my mind when I heard that. This guy knew his numbers so well, his accounting, that just by reducing the drops of solder, he was able to estimate what that actually profits him on his units of production. Do you know your numbers that way? This isn't even taxes we're talking about anymore. We're talking about, do you know your business that well? Okay, because the point of business is freedom. If I don't know my numbers, I can't have freedom. I'm going to be a slave to the numbers if I don't know the numbers. Okay. And so this means that I should have accounting. I should have profit and losses. I should be reviewing it, weekly, not just monthly. The profit and loss is monthly. Weekly, though, I should be looking at what's coming in, what's going out, right? I should be looking at my accounting monthly. I should be looking at my estimated tax liabilities quarterly. Okay. This is the other one that happens is between, the accounting and the tax filing, right? You have something called quarterly estimates if you're a business owner. Okay. Your quarterly estimates are based on what you paid last year, right? And so if you're in this pattern of overpaying in taxes, that means every single year, the IRS is going to look at your tax return and give you really, really high quarterly estimates. And they'll say, great, this quarter, 50 grand, because last year you overpaid in taxes. Okay. And if it's me as a business owner, I don't know what I'm talking about tonight. I'm going to sit there like a dumbass and I'm going to pay it. And I'm going to complain every single quarter. And I'm not going to realize that if I were to fix my payroll and fix my accounting and actually do tax planning, then the next time I file, I could show them a lower number, and then my quarterly estimates would be lower as well. This thing feeds off of itself. The better job I do, the better it is for me in the future. The worse job I do, the worse it is for me in the future, right? Because taxes, they're only going to go up over time. If you look at the lowest tax rates, which was in 1913 when it was very first starting, through till today, the compounding annual growth rates on taxes are about 1.5% increase per year. Okay. In the past, they've been as high as 90-something%. Right now, they're in the 40s at the highest rates. Just like the stock market or bullion, it's going to go up and down and up and down. But I'm saying on average, it's a 1.5% increase, which means in the future, taxes are going to go up. Our country owes more debt, right? We have more economic problems. Like we have all this stuff going on, more countries we're meddling in. It costs more money. Our budget deficits are higher. We're borrowing more from the Federal Reserve. We're going to need to raise taxes. It's inevitable. It doesn't matter whether it's a Democrat or a Republican in office, taxes will go up. I promise you that. And so if I'm not planning to reduce my taxes through these 4 points, then I'm going to be a victim of that system. My taxes are going to continue to go up, right? And they're going to continue to get wasted. Now, here's something I want to share with you. I've said this before, but the tax code is over 6,000 pages in length. Okay. That's our United States tax code. Okay. I've never verified this, but what I've seen and read is that if you were to line up, you were to print out every single page in the tax code and line them up back to back to back, if you were to put it basically on a table and fire a bullet into it, the bullet would not get through the other side. That's how thick the tax code is. Now, here's the kicker. Of this 6,000 pages, only about 30 pages have to do with paying taxes, right? So this means that the other, what does that come out to? The other 5,970 pages are about not paying taxes. Think about that, right? This is why Albert Einstein said the tax code is the most complex thing to understand. He was studying quantum physics, and he said the tax code is the hardest thing to understand. Not quantum physics, not time travel, not E equals C MC squared or whatever the equation is, right? Not square loops or any of that, and any of that stuff he was getting into. He said the tax code. That should hit you. The smartest man to ever live says the tax code. The reason why is there's so much to it, right? There's so much to the tax code. And so I'm not sitting here today saying, you need to learn and understand the tax code. No, I'm saying that's our job. You need to do your payroll right. You need to do your accounting right. You need to actually hire a tax planner so that we can dig through this 5,970 pages and figure out what can we apply to your taxes to reduce it down to zero. Okay. Whether you implement that or not, that's totally up to you. I did a tax plan for a family about a month ago. They went from paying, hundreds of thousands in taxes down to zero. Whether they follow that plan, that's up to them, right? But they can follow it. It's a real plan and they could actually do it. Okay. So again, 30 pages have to do with paying taxes. Most Americans, they only think about that 30 pages. What's my rate, right? This is what the politicians talk about. This is what the media talks about. What's my rate? Nobody talks about you could do a charitable lead trust. right? You can do a charitable remainder trust. You can do a conservative easement. You can do an oil and gas deal. You can do so many different things. You can put money into an opportunity zone, right? Like there's all these different things in the tax code that are ways for us to legally not pay taxes. And the reason why it comes down to two things. There's only two ways something gets in the tax code, right? The first one is government incentive. Okay, government incentive, meaning the government will give you a break or a discount if you behave financially the way that they want you to, right? So that's why we have this thing called opportunity zones. The government wants you investing money in poor neighborhoods. And if you invest money in poor neighborhoods, they're going to give you incentives. They're going to give you tax reductions. They're going to let you shelter capital gains. That is a government incentive. Okay. So that can get put into the tax code by Congress. They're like, hey, we want Americans, buying real estate. We're going to make sure that there's incentives for them to invest in real estate so that they pay less in taxes if they do, right? The other way is lobbyists. Okay, a lobbyist is when a wealthy person or a corporation or an interest, they hire a professional who courts politicians and gets to know them and builds up a relationship and says, hey, my boss is willing to donate to your campaigns in a very large way if you will put XYZ law into place. If you'll sponsor this bill and you get it on the floor and we make it a law, we're going to help you out. We're going to make sure you flourish as a politician. Okay. So the tax code is built by the government. Now, don't fool yourself. These guys that pay the lobbyists are the top 1%. These guys that work for your government are the top 1%. It's the same people. These guys are public top 1%ers. These guys are private top 1%ers. If you look at the highest, I don't know if this is still the case, the highest income area in the United States, it's Washington, D.C. That's the highest income zip code is the Beltway in Washington, D.C. Your politicians are the top 1%. These guys that make the rules, they are the wealthy. They are the ones they're saying, tax the rich. They are the rich. You see the logic there, right? These guys just happen to be private corporations, right? They run Coca-Colas and General Electrics and Mass Mutuals and all these other giant companies. They're both doing the same thing. They're making the laws, and the laws are ways for them, because they're the ones that wrote them, to pay less taxes. Now, you and I, we're not supposed to know about this because we're not taught to go read the tax code. We're not taught to think for ourselves. We're taught to follow the rules, get good grades, get a good job, pay your taxes, pay your mortgage, put the money in the 401k, make sure that the banks on Wall Street get their cut and the IRS does before we do, and then die and be quiet. Okay, so we were only supposed to know about the 30 pages. But because they wrote the 5,970 pages, they know about them, they implement them, they use them, I guarantee you, and they pay little to no taxes because of that. Okay, quote that I put on my Facebook today from David Rockefeller, John Rockefeller's grandson, CEO of Chase Manhattan Bank. He said, I owe no personal income tax. And he said, but sometimes out of the gratitude of my heart, I will send a donation check to the IRS once in a while. Okay, because he contributed to writing that tax code. So we have 5,970 pages to reduce our taxes. Question number one, do you know any of those pages whatsoever? Are you using them? And if you're not someone that knows them, that's fine. Hire someone that does. That's what our firm does. Hire a tax planner. Your bookkeeper that does filing taxes and bookkeeping does not know the tax code. Your sister that does your taxes for free on filemytaxesfree.com does not know the tax code. Your CPA does know the tax code, but they're afraid to use it because they don't want to get audited and because they don't want to do the extra work. Right? If your tax filing cycle sounds like this, like I'm going to show you what most people do, especially business owners. You say, hey, it's tax season. Your CPA says, great. What did you make? You say, well, I made blah, blah, blah. And they say, great. You owe X, Y, Z. If that's how your tax planning and filing goes, you're getting screwed. Okay. Because it should look like, okay, send us all of your documents. We do a review of everything. We tell you didn't send us all the documents, send us more documents. We review all of those. Then we build the plan. Then we go through the plan. Then we implement the plan. Then we file. And a lot of times we're going to file an extension because it's going to take some time to implement the plan. If that's not how you're doing your taxes, you're paying way too much, right? So number one, are you actually using the tax code? Okay, but primary before that, are you even in a position to use the tax code? Meaning, are you paying yourself correctly? Are you doing your accounting and bookkeeping correctly? Because if you're not in a position to take advantage of any of this stuff. Because what's going to happen is we're going to set it up for you, and we won't, but let's say we did. Because what I mean by that is we're going to look at it and say, hey, you're not organized. Like, we can't set up anything until you're organized. But let's say that we weren't that good, and we're like, great, we'll take you on anyways. We're going to deal with you even though you're not organized. Again, we get audited. The IRS says, okay, show us all your stuff, show us all of your documentation, your verification, and we're like, we don't have any. But we did do this. Like, we're a tax firm. We can assure you we did this. The IRS is going to say, well, if you can't produce documentation, we will not recognize any of the tax planning you've done. And again, now you're going to pay taxes, increased, and penalties. So this stuff really matters, guys. Now, the other thing that I want to go into here is the tax rate, right? So the tax rate, we have our tax brackets, and then we have something called a net effective rate. Okay. The bracket is literally just an incentive system. If you look at the tax bracket, they're always staggered. We have our marginal tax rate at the very bottom, and then it works up by income threshold, and you're going to pay X percentage on X amount of dollars. And then you get into the next threshold and you pay X percentage on those dollars. And then you get into the next one and the next one. Right. So a lot of people, they focus on their bracket. They're like, I'm in the 22% tax bracket, 24% tax bracket, the 28% tax bracket. Okay. Well, that means that on this chunk of income, you paid 28%. On this chunk of income, you paid 22%, right? And it goes all the way down to, 15 or 10 or whatever your lowest one's going to be. The bracket doesn't actually mean anything. We want to know, what is your net effective rate? What are the total dollars you paid in taxes divided by the income that you earned, right? So if I'm in a 28% bracket, right? But let's say that I paid $30,000 in taxes. And let's say that was on, let's say just to keep the math even, $300,000 worth of income. Regardless of my bracket, my net effective tax rate is 10%. Okay, this is the number I should be paying attention to, right? I want to pay a lower net effective bracket. I can't do that if I'm focusing on the rate. Right, now think about this. I want you to realize the government's all about control. So when we think about taxes, again, they have up here, we talked about all of this stuff comes into being via incentive or lobbyists, right? Let's focus on the incentives, right? So the government can't incentivize me with something that I don't actually have. So if I have a potential tax burden, the way they incentivize me is by reducing that burden, right? So the brackets are created to give me big, scary numbers so that I behave the way that they want me to. This is part of financial freedom, right? If I'm not free from this government manipulation of my behavior through the tax system, I'm not actually free. Even if I'm a millionaire, even if I have financial independence, I'm still playing their game, right? Put money in the 401k. Why? Because you're in a really high tax bracket. So you should give all your money to Wall Street. Our buddies, by the way, top 1%, they lobbied a lot of this stuff into the rules. So I need to be in a phase where I'm not looking at my bracket. I'm looking at my net effective rate, because the government, they're going to take the bracket and they're going to say, hey, let's raise taxes so that when we give people incentives, they're more likely to follow them. Right? Like Biden talking about raising taxes. Everyone's freaking out, screaming bloody murder. I guarantee you the brackets will go up. The net effective rates won't, because Biden will come out with incentives saying, hey, yeah, it's 50% unless you put your money in these places that benefit us and our colleagues, right? They benefit our friends over here, the lobbyists, and they benefit us, the congressmen and the senators that are also top 1%ers. You guys see that? So by raising the bracket, the number on the bracket, it creates a bigger problem. And then the alleviation of that problem becomes a greater incentive. If I invest in these qualified areas or these qualified funds or put my money into these vehicles or these vessels per the government's incentive, then my newly inflated 50% bracket, it's now only 20%. And so that's behavioral manipulation. Okay, the other one is, this is a little bit of a bunny trail, but I was thinking about this today, capital gains tax, right? Capital gains tax means when you sell something, right? I think they're talking about moving it from like 20% up to 40, right? 40% capital gains tax. Think about that. That's substantial. Like, you sell your business for, $1 million and you don't get to keep $1 million. You get to keep 600,000 because the government took 40% of it. right? Well, think about where we're at right now. Who in their right mind as an investor is going to sell when the capital gains rate's at its highest? Right? We have to think about this stuff because we get all bull baited by the numbers. Like 40%, that's huge. That's ridiculous. Those commies, those Democrats, those Republicans, those this. No one's going to sell at 40%. They're trying to get people not to sell. Think about it. We have stock market fueled by no earnings, meaning the only reason stock prices are going up is because more people are buying than selling. Real estate that's not fueled by any sort of valuation or income, right? The only reason it's going up is because more people are buying real estate than selling. There's more demand than there is supply, right? Cryptocurrency, same thing. There's no earnings behind cryptocurrency, right? The only reason the price goes up is because more people buy than sell. So in an environment like that, where the price is only going up because more people are buying than selling, what would happen if more people sold than bought? If more people sold stock today than bought, what happens to the stock market? It crashes, right? If more people sell real estate than buy real estate, what happens to the real estate prices? They crash. If more people buy cryptocurrency or sell cryptocurrency than buy it, what happens to the cryptocurrency prices? They crash. The government knows if shit crashes right now, we're done. The economy will be totally globally destroyed because everything is propped up by false money. So this is not tax the rich. This is no. Disincentivize selling. We don't want people to sell. We don't want stock prices to crash. We want everyone to continue living on thinking they're in prosperity when they're not. Because as long as the stock market is high and your mortgage is high or your home prices are high and you made some money in your Bitcoin and this and that happens, then you're fine. Americans are going to be totally happy because it seems like prosperity is happening. But if people start selling and the prices start coming down, then everyone will realize we're actually in a depression or a recession. And then it'll start to realize in real life what should be happening, which is we should be in a recession right now. We should be in a depression right now. All of this fake money that came in, like it's not real production. So we should have negative, economic conditions happening. So the capital gains tax increasing has nothing to do with getting more money out of the rich. If they're trying to get more money out of the rich, they would increase just the income tax rates. They'd get rid of the incentives and they would drop the tax code down. Like they'd cut it down substantially. So they're just saying, hey, don't sell your stuff, right? You don't want to pay 40%? Fine, pay zero, keep it all, buy it, hold it, keep it. We don't want the prices going down, right? So you've got to learn to think like this. And this is a new level of financial literacy when you start getting into tax planning like this. Because again, most of us, we never do this basic stuff. The reason why I can pick that apart is because I do my own payroll and accounting and I understand my business. And I understand economics because I understand my own business. So I understand incentives and I understand compensation. I understand rewards and penalties. And I understand that when you sell something more than it's purchased, the price goes down. And so I can put all that together to realize they're not trying to tax people at 40%. They're trying to prevent you from selling your stuff. Because if you sell your stuff, the economy crashes and then we're not winning anymore as a country. We realize what's actually going on, right? So guys, this goes a lot further beyond having a good credit score or owning your dream house or paying off your car. Like that's all great, but that's really like Dave Ramsey baby steps, right? That's baby financial stuff. There's different levels of financial literacy. And so the level that we want you to get to is being able to look at the stuff we just looked at tonight, being able to understand the tax code, being able to understand your accounting. This is another one on the accounting that I want to kind of expand to before we open up for questions. Because I get this a lot is when you become accredited, right? You become an accredited investor and you get access to all these different new deals. If you don't understand accounting, you're going to be in big trouble. Because what happens is you get a private placement memorandum, which is full of just legal nomenclature, like we talked about at the very beginning. Nomenclature. It's full of legal jargon. Any of my clients that have read a private placement memorandum will tell you straight up, that thing isn't even Greek. It's worse. It's cave writing. Like you can't understand anything a private placement memorandum says. You get that, you get the subscription agreement, and then you get the financials. And if you can't read a financial statement, then you're prone to be taken advantage of. Okay. I can tell you just off the top of my head, 2 people that I know that invested in private deals. Not my private deals. They've invested in other people's private deals with an LLC, with a buddy that was investing and raising money for a business. And it seemed so great. and they didn't look at the P&Ls and they didn't look at the accounting. And even if they did, they wouldn't know what any of it meant because they're not looking at their own stuff. And then their buddy shuts down the LLC and starts a new one with the same product using their money, but under a new name. And they can't touch him because an LLC has a veil of corporate separation. If I invest in LLC A loses money and shuts down, I just lose. But the CEO or the owner of LLC A can go start LLC B, which sells the exact same product as LLC A, could use my investor money that I put into LLC A as a capital contribution, and I can't get any of it because it's a totally different business venture. It should be fraud, but it's not, right? That's the way that things work. And if I don't understand accounting, I'm putting myself in a position to be vulnerable to that type of stuff, right? So guys, I know we went on a lot tonight, but the big thing that I want to focus on is the payroll, right? It matters how you pay yourself, how you record your income, how you report your income, how much, when you do it, all that stuff, the accounting, what are you spending money on during your year, your operating expenses, your strategic expenses, having your organization for your records, for your tax planning, being able to understand accounting. So when you do investments, that's all in place. And then actual tax planning, right? Like doing a tax plan proactively before you file, and then finally filing because you've got everything in a row. So I want to open this up for questions here. Let me go ahead and see what we have on Facebook. If you guys are on Zoom, I want you to drop your questions in the comments. We'll go live. By the way, if you're on Zoom, when we go live here, make sure that you don't have your microphone next to your speaker. Sometimes I get feedback from you guys on Zoom because your mic is lined up next to the speaker and it does a double echo and I can't actually hear anything but me talking twice. So make sure that you've got the mic away from the speaker. All right, Facebook, what's going on, everybody? Good to see you, Justin. Good to see you, Ben. Todd, good to see you. Sean, good to see you. Ryan, good to see you. Ryan's rub your belly comment made my night. Nano, good to see you. Sean says, I'm tired of paying the government for them to mismanage my money. How can I speak to your CPA team? Sean, reach out to Nano Aquino. Nano can get you set up with a tax what if plan. Nano, connect with Sean King with that. And that's basically us reviewing your taxes. Now, be forewarned on the tax planning, like if you're not doing your accounting, if you own rental properties, if you have a business, if you have a side hustle and you've not been doing accounting and you hire us for a tax plan and we find out you haven't been doing your accounting, there's a very high chance we're going to say, hey, we need to do your accounting first because we can't base your tax plan off of nothing. So just forewarning on that. Let's see what we have here on Zoom. Great to see everyone tonight. All right, we have a question here from Nano. Let me go ahead and bring Nano on live.
Hey, Jerry, what's going on?
Hey, Nano, I'm good. How are you doing?
Doing great, man. And you?
I'm great. What's your question tonight?
Good. So what recommendation do you have for someone who to prepare for taxes if they are 1099? Does it matter where they are on the blueprint phases, or does the planning and accounting has to take place regardless of where they are?
I think I'm catching. I'm getting a little bit of double. So the Nano's question is if you're on a 1099, I think he wrote it down here too. Let me scroll down because that is a little bit of a double feedback loop happening. What recommendations do you have for someone preparing taxes if they're on a 1099? So the first thing to realize is there's no such thing as on a 1099. A 1099 is a form of income. It's not a form of tax filing, right? So a 1099 is a way that I get paid income, right? I'm a business owner. I have corporations. I receive 1099s from some of my vendors. I receive 1099s from some of my lending deals, but I'm not on a 1099. I'm either filing as, like we said here, a Schedule C, an S Corp, or a C Corp. So a 1099 could come into my hands, but if I'm filing as a Schedule C, that's going to be paying as Schedule C income. If I receive a 1099 as an S Corp, I'm going to be paying taxes as an S Corp. If I receive a 1099 as a C Corp, I'm going to be paying taxes as a C Corp, regardless of the 1099 itself, right? So a 1099 isn't a thing you're on. It's not a type of tax filing. It's literally a way of payment transmittal. It's a form of income classification. So the first thing I would say is if you're a 1099, you need to figure out, am I a Schedule C? Am I an S Corp? Am I a C Corp? Now, regardless of which one you are, you need to have yourself set up on some method of payroll, meaning when you receive income, you have a way of classifying that income, paying yourself a certain amount for a certain reason at a certain time. Second thing is you need to have accounting, right? So if you're like brand new, Schedule C, not doing anything yet with business, not expanding out, not hiring people, use our tax.wealthdynamics.com feature. We have a program called Keeper Tax. We have another one called Tax Bot. That'll log all your transactions so that you're doing accounting, right? Now, the other thing is, if you are running an S corporation, you are running a C Corp, you do have employees, you do have staff, at that point, you could hire an actual accountant. We have an accounting firm and we can run that for you. Now, as far as tax preparation, it's then turning in your documents to us. We'll put together a tax what if plan and tell you, hey, here's what we can do before you file. Here's what you did last year as far as deductions. Now, keep in mind, we can't do stuff retroactively. So we can't be like, hey, we're going to do this now based on last year to reduce taxes because last year already ended. So that's the importance of the accounting. So that would be my recommendation. If you're receiving 1099 income, figure out what type of filing you're doing. And then based on that, you're going into it with that type of actual tax filing. Let me see here. What other questions we have? Jazwan says, love this. We should definitely get our accounting and taxes right to achieve financial freedom. Absolutely. Heidi says, I don't understand C Corp. C Corp, C Corporation. So it's C like the letter and then corporation, or S like the letter S and then corporation. Jason asks, what are you writing on? This is just an iPad, note feature hooked up to my TV screen here. I think Jason is in the industry as well. Hope that helps, Jason. Let me see here what we have on Facebook if we have other questions. So Andre asks, how do you ensure and document that an expense is an ordinary and necessary business expense? So with that, part of it is intent, right? So if I actually did have the intention of using it for business, whether that was marketing or prospecting, so that's going to be, part of it is an intent, right? Intent. And then I need to have documentation. Okay, now documentation can be, obviously I want to have my profit and loss, but that's not necessarily documentation. That's a summary statement. I want to have a bank statement or a credit card statement or some record of the transaction so that I can prove that it actually is a real expense. And then the other part is circumstances, right? Circumstances meaning what was the circumstance of the transaction? Was I actually doing business or was I doing pleasure and I just tried to write off my business? So the intent and the circumstance are fairly linked, meaning if you are in the right circumstance with the right intent, then it makes sense that something is a business transaction. If you get audited, as long as you have these three, you're going to be fine, right? Now, if you have intent and circumstances, but not documentation, that's where they're like, hey, we can't let you have a business write-off that you can't document. If you have documentation, but you can't prove intent and the circumstance of actually doing business, then that's not going to help either. So these are really kind of your big three on that question, Andre. Great questions. Let me see what else we have on Zoom here. All right, we have a question from Jorge. Let me go ahead and bring Jorge on live here. All right, we are live with Jorge. How are you doing today, Jorge?
Good. How about yourself, Jerry?
I'm doing great. Thanks for asking.
Yeah, my question was, is there a book or a website that you recommend in taxes then we can have it for reference.
Yeah, I'm getting a little bit of feedback again. Jorge asks, is there a book or a website that I recommend? As far as books, if you go to our website, we do have a reading list, and we have a couple of books there. With taxes, there's a book called Tax-Free Wealth. That's a great one. You can also just go into the tax codes. If you go to the Cornell website, you can actually pull up the tax code there. And so you can actually dive into and study the tax code. If you get into Wealth Dynamics University, we also have a lot of material on taxes there as well. So we have several courses you can go through on tax reduction, tax strategies. One of the best ways to learn tax filing and planning, though, is going through this process with us. So we do, let me find my sketch here. So we do something called a tax what if, which is tax planning. And so one of the easiest ways to become educated on actual taxes is when we do your tax planning, we'll say, hey, we're going to do XYZ strategy. Like we might say, hey, we're going to do a charitable remainder trust. And you're like, well, what the hell is that? And then we'll actually have you go learn about what a charitable remainder trust is. And part of this with taxes is there are 5,970 pages. Let me find my spot here. Right here, 5,970 pages. Not all of them are going to be relevant to you. And so what I did is I read through everything I could get my hands on about taxes. And there's some stuff I've never used, right? And so what I would recommend in hindsight is learn about what applies to your situation by going through the planning process and actually getting your tax what if done. And then as you go through and learn about, okay, we're going to do this strategy, we're going to do that strategy, you can actually pick those out then and learn about them specifically. And actually, it'll actually help you apply it because you'll see it, you'll get mass on it right away, rather than I learned about 60 different strategies, didn't use any of them, forgot them all. And then when we are actually go to use one of the 60, I don't remember it because it wasn't something I used right away. So if you go to our website, again, you can go to the recommended reading list, grab some material there, but I would highly recommend just doing the tax what if and learning about it from that standpoint.
Sounds great. Thank you, Jerry.
Sorry about my mic feedback tonight too when we're answering questions. We'll have to get that looked at. Let me see if we have anything else on Facebook before we wrap things up tonight. Doesn't look like it. Let me make sure we've got nothing else on Zoom. Awesome. It looks like we answered all of our questions. So guys, I'm going to tune out for tonight. If you are watching for the first time or you have not grabbed a copy of my book, Blueprint to Financial Freedom, we have an entire chapter in here. It's going to be chapter 5 on avoiding the financial traps. And so part of this is talking about taxes, right? So if you have not got a copy of this book, Blueprint to Financial Freedom, this is going to help you with not just tax filing and planning, but really everything financial. And Jorge, if you've not grabbed a copy, this might be a good one for your question as well, and a good book to read. But that's going to walk you through the strategy, because taxes are a part of the blueprint. It's like, saying I'm building a house, we're going to work on the windows right now, right? There's still a whole lot more to the house that we've got to put together. So that's what I would recommend. We do these every week. So if you didn't get to tune into this one live, you're catching the replay, you can tune in on Facebook and catch us live 10 p.m. next week. Thank you for watching this time. Like, share, and subscribe. I'll see you guys all next time.